Let's get a check on the markets now. Joining us for that is Paul Hickey, co-founder of Bespoke Investment Group, and Stephen Suttmeier. He's chief equity technical strategist at Bank of America, Merrill Lynch Global Research. Good morning to you both, guys.
Morning.
Steve, let me start with you in terms of the overall market setup. The last several days in the market, it's become kind of clear that in August, markets seem to have overshot in a few different directions, right? Yields were very, very compressed. Stocks at the S&P level went down 6%, but a lot of different stocks moved in different directions. So you had defensives winning, cyclical stocks losing. Yesterday was actually a violent rotation day below the surface. A lot of those momentum stocks losing ground and value coming up. Where does it leave the overall market? Is this just a snapback type move, or do you think there's more to the rally?
No, I think there's more to the rally. And what we saw entering the month was extreme pessimism for equities. Put-call ratio is as high as it was in January for equities. Also, when you look at short interest, the percent of total flow of the market, it actually went to the highest level since February 16. This happened at the same time traditional market breadth indicators were improving, like the advanced decline line was going to a new high. You also had high yield and investment grade indices breaking out. So this led to the breakout to the top side of that range that formed in August. So through, make it not round numbers, through 2950, I think, puts a target on the S&P, short term, around 3060 to 3100. And that breakout's firmly in place as long as you can hold roughly around that gap up that we got. The upper end of that, or upper end of the gap is 2960. Lower end is about 2938.
So 3,100, that's about, 2-3% into record territory versus where we hit back in July. And just quickly, I mean, you're looking at exactly how we might get there within the market, because if it continues that the big growth stocks that are so big in the S&P 500 aren't really leading the way, is there enough that's going to work that's going to get us there?
I mean, if yesterday was the start of a rotation, right? I mean, you saw growth get trounced versus value. You saw defensives lose versus, more cyclical areas. So, I mean, I don't think that it's the end of the world for technology or, software names. But I think if, for instance, if people came in very pessimistic on equities, they were pretty bullish on bonds. So yields have backed up. So maybe there is a bid here to financials for a little while that could pile this higher. And also, breadth was positive yesterday, at least when I last checked.
Yeah.
So, I mean, the market breadth indicators could continue to improve. So that's what we're focused on. So I think you can see more broadening out of the sector level.
The equal weighted S&P was, I think, up 0.5%, even though the S&P was flat yesterday. Paul, listening to all the stuff about these shifts, if it's the market kind of reassessing the economic picture and say, hey, we over-anticipated recessionary risks in August, yield should be higher, therefore stocks should be higher, that's a good thing. If it's people who were kind of trapped in trades and had to quickly exit yesterday, not the best thing. How do you see it?
I think as a corollary to what Steve was saying, in the bond market, sentiment, where sentiment towards equities was very negative, sentiment towards interest rates in the consumer confidence report at the end of at the end of August, the August report, the percentage of people expecting lower interest rates was the highest number we saw since early 2009. So we're at record low interest rates, and people are expecting further declines in interest rates. At the same time, the Citi Economic Surprise Index was just ending one of its longest streaks of negative readings on record. So you're seeing economic expectations reset to the conditions on the ground. You're seeing sentiment extremely offsides towards bullish on bonds. And that sets the stage. If we start to see this economic data even come in line with expectations, it reduces the negative headline risk of these weaker data points and can take some of the luster off of bonds and move people into equities and increase the sentiment flows there.
From the technical perspective, all this talk of it being a potential for higher stocks, higher movements from here, is there a chance for a melt up, or is that just crazy talk at this point?
Are we there yet, Stephen?
Well, I mean, the way I look at the market, it seems like we have a similar setup to 2016, 2012, where you rallied sharply, but there's a lot of doubts about the rally. So there is a chance that could happen. We had a melt up in late 2016 after the election. I don't know what the catalyst to provide that is this time around, but is the setup similar to past periods where you've seen, significantly higher highs, like from mid-2012 into, 2013 or late 2016 into 2017, 2018? And I would say the answer is the setup is there for that to happen.
We've seen the 200-day moving average flatline over the last year. We saw it again in 2016. We saw it in 2012. And at those same periods, the catalyst for a melt-up, no one ever knows the catalyst for a melt-up beforehand. So, I mean, every time before those melt-ups, there was never, oh, this is going to happen, the market's going to go higher. So no one's ever expecting it. But when we've seen these tight ranges in the 200-day moving average over the last year, it's one of its narrowest ranges on record, you tend to see that resolved going forward with the market moving higher rather than lower.
Yeah. Market hasn't done anything in a long time, actually turns into a bullish observation as opposed to saying.
Right. We saw three big legs higher during this bull market, and now we're in the later stages of a third consolidation period.